Stock started the week with a very small move higher or lower, depending upon the index you're looking at. But we have a busy week ahead. So we're going to break down today's move in that context. We're going to talk about what to expect. We're going to look for a stock that has earnings coming up tomorrow and how we might be able to trade that with our trade idea of the day. We'll take a look at what's driving this price action right now and as well as looking at some major asset classes and what their long-term trends are, and if we see any major shifts developing in some of our expectations that we've had heading into the rest of the year. So let's go ahead and get started. Today is Monday, February the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast on the S&P 500, and you can see we had an update today, second update in a row. Not on the Dow, though. The Dow was down for its fourth consecutive day. Small gains, very small range, very small volume, not very much of a day, as you'll see. You can see the lines are drawn still, kind of the expectation of retracement down to the red retracement lines because of the resistance that we're at here at the blue retracement lines, which are the this bullish retracement of the previous bearish move from 2940 down to 2350, so almost a 600-point move there that we bounced up off of. That's what the blue lines represent. Of course, the red lines would be any kind of pullback from low to last week's high. Any retracement of that, of course, the fans also from the 2940 high to 2346 low. You can see where they kind of cross and they connect. These to 62%, which is the one we've already crossed above, where it connects, crosses the other retracement lines, kind of in this 2575, 2600 area. Would obviously be past February expiration towards the end of the month, according to the cycle that we're on right now. Would also produce would be below the moving average. If that's the case. Remember, we're not above the 200-day moving average yet. We're kind of flirting with the 40-week exponential, as you'll see here in a second. But the posture remains strongly bullish and long-term market sentiment's rising. We're still got this bullish bias right now. We just haven't had that retest yet. Of that low that we typically see when we're coming up off of surge lows like this point, which ended up being even more of a surge than we saw here earlier in October. The near-term line's producing a bullish low point right now, so it would be a higher low compared to the last near-term low. Only a day below 50 and bouncing back up is a positive sign. So now the next expectation is for the blue line to get above 80, and that would kind of continue the trend. And if it doesn't, then that would be, another sign that we might be in, especially if we don't get above last week's high. Now the Russell is already almost above last week's high, and it's got actually a lot more bullish short-term sentiment than what we see on the S&P, especially on the Dow. The Dow, the near-term line didn't come up; it came up a smidgen, right? It's still below 50. Didn't cross up above 50, so it's a little bit more of a pullback than what we're seeing on the small cap index. But that's actually a good sign to see the small caps outperforming large caps still. So eventually stocks can still go up with large caps outperforming. That's pretty indicative of late cycle type moves because large caps, especially Dow Jones, tend to be more safety oriented. They're the blue chip companies, and the fact that the Nasdaq is kind of matching the S&P. So it's actually holding up pretty well too, but the Russell is bullish, so it's a good sign for stocks. That, again, we would like to see more of an exhale that's more regular instead of these kind of shallow pullbacks. I saw somebody mentioning how these were like pullbacks here, and it's like, well, these are very shallow pullbacks. You'd like to see that hiccup that on the intermediate line where we test the 50-day moving average coming up from below it, where we test the 200-day moving average, produce a stronger low point that we can bounce up off and sustain a longer move. We continue to bounce up here, we can go up to 2800 easily, right? That's not out of the realm of possibility at all. In fact, it's probably a higher probability of that happening, considering the bullish momentum the markets have right now. But it wouldn't serve to sustain a longer term move going forward from there, like a pullback, a more of a regular pullback would. So that's the concern, and that's the anticipation. The expectation is probably by the end of the month, if it follows the cycle, If not, we continue higher, then we'll have to move this cycle out further. Because that's, this is on the bearish cycle, not necessarily on the bullish 3 to 4 month cycle that we saw here previously. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Click this red subscribe button right below the video. You can also mouse over our logo on any device here in the bottom right corner and click that red subscribe button there. Also, hit this thumbs up icon. Again, that tells us two things. Number one, that you like the video today. Number two, you want us to do the video again tomorrow. One click way to give us feedback. Again, whether you click thumbs up, whether you click thumbs down, whether you comment, the more you do those three things, either one of those three things, or two of the three, if you hit the thumbs up and hit the comment there, then the more YouTube sees this as an engaging piece of content that they should share with others. Again, the worst thing you can do, if you don't like the video, actually the worst thing you can do is not click on anything. Because YouTube likes engagements. Even if it's thumbs down, that's good for us because YouTube looks at that as engagement and something that they think that other people would want to engage with too. Also, click this right below the video here on the blog. Click this heart on tonight's Market Outlook tweet. That will like it. You can click this like button right there. You can also click on the image. It takes you to your Facebook account, excuse me, where you can like today's Market Outlook post there. Again, same thing. The more you click on those things, the more you're telling them, Twitter and Facebook, that you want to keep getting our stuff pushed to you. That you like our content, and the more engagement there is in those pieces of content, the more that they'll promote it to other people as well. So you can see here on the long-term chart that we are kind of hitting up against this 200-day moving average. You can see very small range so far this week, only one day, but you also see the doji we had last week, and that's a little bit of a sign of caution. And now we close above last week's high, fine. If we close below last week's low, that's a little bit of a different story. And you take a look, and again, not that we would turn into a bear market, just a different story in terms of this little unabashed rally we'll finally get that exhale that we've been kind of looking for. You got the one red arrow on the MACD. You look at, if you were to break those lines out, you can see we're below the moving averages in both the MACD and the stochastic. Stochastics hasn't crossed that %K line, which is a 5-day slowed %K line. That's the full stochastics. It hasn't dropped below 80 yet, which means the 5-day closing average of the S&P is still up in the upper quintile of the last 20 days or 14 days. So still, but below its moving average, right? So it is showing some weakness there. Same thing with the MACD, but not any kind of. We still haven't even closed below the 8-day moving average yet. So take any kind of weakness with a grain of salt there. Today's trading range is really small. You can see it visually here. We did get a higher high at the open, but we didn't stay above the open very long, or Friday's high for very long. And we did get a higher low because we didn't test last week's low, which was Friday's low. But you can see how tenuous this is. Here I just moved that purple line up to 267.11. That's the open of this week's Hakunashi candle and SPY. Which is really close to last week's low. So that's why I say, and by the end of this week, your 4-week range is probably going to be up there too, probably in this area, because again, the low point is going to move to there in a couple of days, and then up to here by the end of the week. So we're looking for a move about 4.5 points, 3.5 points. So you add another point and 3/4 to this, you're looking at almost 267. So you're probably going to be in this range right here. Where the 4-week range will be, 4-week midpoint will be by the end of the week. So you test down into 266 area. Just the 266 would not be that big of a deal. We're going to be below some intraday support, some relatively weak support because of the time frame, but support nonetheless. And again, may lead to more. You can see a little bit of a potential inverse head and shoulders, but again, that's over on a daily intraday chart. So grain of salt in terms of how reliable, number one, it is, and how impactful, number two, it is. But very light volume, very small trading range, so not surprising. Mondays tend to be that way unless there's something that that was announced over the weekend. but you can see the range was less than a point and a half. The volume down there is 68 million. So put those two numbers in context here. A point and a half range is way down here at the low, below the low end of the 52-week range for the average. 68 million is also way down here too. All these lines are falling, which is a good sign. You look at the volatility for the VIX. It didn't drop very much today. Was actually up today, 1.6%. Still in the neutral zone, so it hasn't broken the 90% yet, where we feel really good about the potential for a long-term trend continuing. So we'll see if we do get any kind of near-term weakness and a move on the VIX back up towards 20. More than likely we'll get a move back up on this towards that 1 area. So just keep that in mind. If that happens, it wouldn't be a bear market, right? We wouldn't be all of a sudden worried about failing at the 200-day moving average. It will just simply be the retest of this low point that we had over here in Christmas Eve that we haven't had since. So, you can see the volatility chart. Typically you get this spike and you get a retest. Well, here's our spike and no retest yet, right? Here you can see it better if I go out. Let me go out 5 years, and you can see the daily chart, right? So you have, here's 15. You have big move and a retest, big move and a retest, big move here, like you're seeing these others, and we haven't had this move yet, this retest. Or, even if it's not a couple months away, if it's even this move here, we even haven't had that move yet after there. So, that's the kind of idea. And you can see too how we haven't broken below into this half, this part of the volatility chart where we would expect to be more bullish for a longer period of time, kind of that constant upward grind. We're not in that mode yet. So to summarize the outlook, the posture is still, the momentum is still strongly bullish and can still carry us up off of what is a short-term low point, bullish low point to potentially 2,800, right? We can still continue higher, but it does appear to be like we're running out of gas. The ranges are getting small, the volumes are getting small, but not small enough, and volatility is low, but not low and small enough that we can say, okay, we're going to be bullish for a while. We haven't had that nice little retest low point that we can build a more solid base off of to build on. Right now we're still kind of grasping to see how high we can get before we get kind of any retest. And so the odds of us getting it, even touching 2350, are very, very low. But it doesn't mean that we can't move down towards 2600 or a little bit below that and still just be simply a Fibonacci retracement and still be very strong support in that area and still be very, very normal. While it may not seem normal at the time, if it were to happen, it may not, that there would be a lot of a lot of gnashing of teeth if that happened, but it wouldn't be that big of a deal, and actually would be much, much better for everybody in the long term if you're looking to set up build upon a better foundation for these longer term trend trades. So what do you think? Do you agree with that or disagree? If you there's a poll popping out in the top right corner of your screen, click on that poll and then hit either agree or disagree. If you click disagree, then scroll down below and comment on what you see that's different than what we came up with here. Remember to follow me on Twitter for more content like this throughout the day in between the videos. Join our Market Outlook community that we created on Facebook, and join our daily Market Outlook email list that we put together. There's a link popping out there. Click on that link. Very, very easy way to subscribe. You can join our site for free at marketscholars.com, and at that time sign up for the email list there as well. Alright, now let's take a look at what's driving price action today. You can see very, very flat day on high yield bonds, on preferred stocks, on the S&P 500. The one outlier to the upside was actually small cap stocks, which is a good thing, but you also see the dollar was a big outlier to the upside. The dollar's been relatively strong here lately, and we'll take a look at it in a second. You can see gold obviously then having the move to the downside. You can also see treasuries yields were up with a strong dollar today, so long-term bonds are down. Crude oil started the day really weak, down 2.5% before rallying and finishing with a much smaller loss. So kind of an interesting pattern. You can see the differences here from top to bottom on who did best and who did worst today. Gold and long-term bonds, commodities, crude oil, emerging market bonds, all struggling the most today. So here's the dollar and the weekly chart it's having, and so you can see a good close, a good open to this week, closing up above this week's last week's high point. If you look at it on a daily chart here, you can see the nice good rally it's had, about an 8-day rally, the longest streak it's had this bullish in quite a while. You can see it's still in the Fibonacci retracement zone. The black line is kind of the long-term view. We're still in that retracement zone. The pullback is still to about the right to 23% Fibonacci. We haven't really pulled back down from these highs as significantly. That strong bullish posture right now on the dollar, according to the intermediate line. Dark green shading, dark green moving average. So maybe a little bit of a change in tenor here. Now, until we break out, I'm not going to be too bullish on the dollar, but that's a pretty good bullish combination to see dark green shading and a dark green moving average in terms of the potential for a bullish trend to develop here. You can see from these trend strength indicators down below, we do have the beginnings of a weak bullish trend. We got above 50, we got above 1 here, so we have the beginnings on a daily chart of a weak bullish trend, but still on the weekly chart, we're not quite, we're still in a noisy period, so we haven't really started a bullish trend. That's why wouldn't really put a whole lot of eggs in that basket quite yet. If you take a look at crude oil is still in a very strong bearish trend, or at least a moderate bearish trend there. We have weakened a little bit, not as strong as we were, but you see the pullback and the reversal, so kind of interesting to see how that's playing out. On the other hand, gold is still in a pretty good moderate bullish trend. So it's kind of, you have this dollar which is kind of in this non-trending mode, but then you have gold and crude oil which are doing kind of the opposite, right? Whereas gold on one hand is on a relatively strong bullish trend, gold on the other hand, or crude oil on the other hand, is not doing anything. It's more bearish. So we'll see how much longer that plays out. The 10-year note here had a really down week last week. Up this so far today, but you can see its bearish trend is starting to strengthen here on the long-term chart. Again, these other signs, the strength in the gold, the weakness here in yields, would suggest maybe we shouldn't be too bullish on the dollar, even if that daily trend is strengthening. Still a lot of noise still on the weekly chart. The economic calendar was really light today. Again, very typical of Monday. We talked last weekend about the earnings calendar. It'll start to pick up a little bit this week, but with some names, not a whole lot. This is a light week, relatively speaking. From an economic surprise index, you can see one reason why the dollar has a little bit of strength is because the discrepancy in economic indicators here in the U.S. versus globally. Now, it's not really lifting economic rate hike expectations. That's why any bounce in yields right now would be temporary until you see some rate hike odds start to increase here in December. Still very, very low and still decent. I mean, it's not as low, not as high as they were before, the day before, the odds of a rate cut, but still higher there than for a rate hike. Finally, when you look at how the foreign markets are doing, you can see, pretty much all of them here are, they're all green shading. There's a few that are red. You've got a weak bearish posture in Brazil. You got a stronger bearish posture in India, and you have weak bearish postures in Japan and Germany. Kind of these big developed areas. Everything else still up above, green with above rising moving averages. A little bit of a threat here in Italy, coming close to its moving average. You can also see Brazil giving this potential for this intermediate pullback right now. Everything else strongly bullish, right? China, the U.S., UK, France, they're all pulling back. Canada, Russia, Korea, they're all pulling back towards bullish trends, but they also have strong bullish postures with their intermediate lines here above 80 and above 90. So weakness right now, your weakest area among the major economies is in India. You've got a strongest bearish posture, and you're below a falling moving average, and then of course Germany and Brazil flirting with that moving average. Now remember, Brazil's got some pretty decent 3-month gains still, relatively speaking, compared to all of its counterparts. In fact, if you look at the the last 3 months, if it'll let me click on it, there we go. You can see Indonesia, Turkey, Brazil, Argentina, some of your more aggressive emerging market names doing well. There's Korea, China, emerging markets all doing, Thailand, Poland, India, and then not until you get to the bottom, you can see Germany, Japan, France, the UK, all with your biggest losses over still the past 3 months. So, so still some outperformance, and even when you look at EEM, emerging markets, relative to the ACWI, which has the big U.S. influence, there's the U.S. markets here in large caps and small caps. EEM has been an outperformer, and that's a relationship that we would expect to continue if the dollar is unable to really get some strength going and maintains its moderately bearish trends that it has on long-term charts. All right, look at sector rotation today. You can see that industrials were your biggest winner, along with energy. They were both of these were up. Technology, healthcare, utilities down. The biggest outlier was the communication services sector, and you can see why. You have Activision Blizzard down 7.6%. Take-Two down almost 4% today. Media companies, CBS, Viacom, News Corp, Discovery, all these media, Charter, there's Discovery there, all lagging behind. So really down day for media companies and gaming companies. As I mentioned, industrials and energy were your biggest winners in the upside. Not as many individual stocks in those names. A lot of consumer discretionary companies, restaurants, toys, Newell Brands, all of these stocks doing very well, as well as some staple companies. There's your first industrials, FedEx, Grainger, GE, all with your biggest winners. There's a railroad company, a few healthcare companies doing well today too. If I were to zoom this chart out to the last 10 days, because a lot of times your biggest winners will pull back and your biggest losers will start to bounce. Well, if I go back out the last 10 days here, and you can see industrials have been and continue to be a big winner. Utilities, you can see utilities and technology have been big winners too, so you could expect them to lag. You would expect some outperformance eventually. There's communication services really has taken a dive over the last 4 days, from being really good, strong winner to now lagging behind significantly. Financials, they're lagging behind with the drop in yields. Materials, despite some strength in gold, materials also lagging behind too. Interestingly enough, real estate has been a gradual climber. It started strong, and over the last week plus, it's been a gradual climber here. Real estate, industrials, of course, is still an outperformer. Technologies, financials really pulling back. So, if I were to zoom this out just a little bit more to go, let's say now 4 weeks, so it'd be to the 15th here, and let's do this at 20 minutes. Kind of double the chart there. You can see, okay, real estate and industrials and technology, all kind of your biggest winners. There's utilities still holding up relatively well, and coming up from some underperformance, along with staples here, the pink coming up. But look at energy and materials. That strength in the dollar has put a lot of pressure on those two areas. There's communication services and financials, which had been a strong performer, is now flipping the switch. So not a lot. I wouldn't put, you can see if I were to take a look at the long-term chart here for financials, it's unlike the S&P, which is kind of broken through. Financials looks like it's meeting up with some resistance here at the 200-day moving average and kind of struggling getting up through that. In fact, let's take a look really quick at the 12 grid for all the major sectors. Alright, here they all are and ranked in order of their sector selector rankings from Brandon's weekend update. And you can see real estate, utilities, interest rate sensitive areas showing some overbought clusters along with staples down there at the bottom. So your safe haven sectors all showing overbought clusters more than any other. They're all above rising moving averages, every single sector, even though energy and materials actually showing a weak, the only one showing a weak bearish posture. But you can see financials down 3% over the past 3 months. You got staples and energy down, showing the only one showing bigger losses. And it hasn't broken its moving average yet. That financial sector hasn't broken through, but has really kind of fallen off in terms of relative strength compared to its counterparts. If you take a look at the relative strength of financials to the broad market as a whole, it's on a bearish trend, on a long-term bearish trend. It had some relative strength here at the beginning of the year, but now back below its 50-day, the relative strength back below its 50-day moving average. The RSI still in the lower half of the chart. MACD trying to bottom out, but unable to really gain some traction going upward. So still not I'm not buying into financials yet, especially if the falling yield has an impact on this particular sector. Of course, this is what happened the last time the Fed stopped raising interest rates. Here, let me actually zoom back a little bit further past 2006. There we go. Now you can see here the Fed stopped raising rates in the middle of June 2006, and we started to decline on the relative strength basis all the way through. Now, keep in mind, financial sector got hit pretty hard during the crisis, so big time grain of salt there. But again, the idea is the financial sector generally does not benefit from a falling yield environment, and that's the expectation with the Fed being done with their rate hike cycle. One stock that I want to take a look at actually has earnings coming out tomorrow in that technology sector. You can see here is Akamai Technologies. It's on a good, increasingly stronger bullish trend with some decent volume today heading into that. You can also see its market forecast looks very similar to the broad market as a whole. Strong bullish posture, a bounce in short-term sentiment. You look at the Bollinger Bands, and you can see that we're heading into that 70% volume channel that we had been below. So we're making our way back up, or getting up above that, or pushing up the upper band after getting above it last week. We got some volume resistance as we head up, especially at the 72.5 level. And again, with earnings coming out, we have the potential for a bigger move. So what if we said, okay, well, we know there's resistance at 72.5. What if we sold a call there and bought the 70? So here's a long call vertical spread, $2.50 wide, and we're going to March. It's a dollar credit. We'll probably get right around, depending upon where we get filled in, about $1.13, which means we'll get about $1.13 would be our maximum loss, $1.37. So better than 1-to-1 reward to risk ratio. But then let's cover the cost of that by selling another 72.5, because we know there's some pretty strong resistance, volume resistance in that area, even with earnings coming up. So we'll cover that 113 cost with another short call. So this would be a naked call at 136. Now, if you take a look at if that earnings turns out being a risk factor to the downside, then we can cap our losses, or cap our worst case scenario to the downside at a $46 gain. All right, because both those short calls will expire worthless, and so will the long call. And we did 2 short calls, so we'll get more credit. If we do go up towards resistance, then you can see our maximum gain goes up to about $286. Well, for us to do this trade, to cover the margin of that naked call, will take us $1,000 of a margin requirement to set aside. So we get about a 20, almost 30% return on our risk if we get up and close up. Analyze that trade. If we get up there and then close up above, or right around that 72.5. Of course, if we get on through it, then my break even's up at 75.5. And you can see 75.5 now. We'd really have to break through the biggest volume node plus another big strong area of resistance for us to get to the point where we would lose money on this trade to the upside. So we have, the volatility tells us we have about an 81% chance of making something on that trade. The reality is we probably have an even higher odds than that, because of all the resistance that's sitting up there. Alright, well that wraps up our market outlook video for tonight. Now I want to hear from you. Remember to use that link above the video in our blog post to visit our forums, our market outlook forums on marketscholars.com. You can subscribe for free to our site and be able to participate in those forums and be able to ask me questions or comments that you have about anything I discussed in tonight's video. Do you have any questions or comments about something market posture related that I did not cover in tonight's video? You can be able to share with other market scholars there any thoughts or insights that you might have that you might want to share with the community too. As always, thank you again for watching. Have a great rest of your evening, everybody. Remember to subscribe to our YouTube channel, click that thumbs up icon and comment. Follow me on Twitter for more content in between videos, and join our community on marketscholars.com, as well as our Facebook community that we created for the Market Outlook. Have a great one, everyone. We'll see you all next time.